The camera cuts in on flashing red screens. 30-year Treasury yields leap to 4.82% after a $25 billion auction craters with the weakest demand in nearly 2 years. Reuters calls the bid-to-cover ratio an ominous sign, the lowest since late 2023. For Washington, that means the government just paid more to borrow money. For investors, it signals hesitation, confidence no longer automatic, even in the deepest market in the world. 10-year yields jump in tandem, touching 4.24%, pulling mortgage rates higher and reshaping every loan tied to the benchmark. Bloomberg reminds us, yields have held above 4% for 3 straight years, a stretch not seen since before the financial crisis. Scott Bessent, overseeing the Treasury, isn't raising new money for bold projects. He's refinancing old obligations. Each sale is just a roll of the debt treadmill, and the treadmill is speeding up. Initial jobless claims tick higher, rising by 7,000 to 226,000. Normally, that kind of labor weakness would send yields lower. This time they climb. Productivity jumps 2.4% in the second quarter, another figure that historically would cool inflation fears. Again, yields ignore it. MarketWatch notes the bond market is flashing a potentially worrisome sign about the effectiveness of Fed rate cuts. Data that once steadied markets now barely registers. Then a policy swerve. U.S. Customs issues guidance. 1 kilogram and 100-ounce gold bars are subject to a 39% duty. Imports from Switzerland, the refining hub that supplies nearly a third of U.S. demand, face a barrier overnight. According to Reuters, Switzerland exported 7.8 billion francs of gold to America last year. That channel is now in doubt. The hedge investors turn to when Treasuries wobble suddenly costs more. The market recoils. December gold futures rocket to $3,534 per ounce, an all-time high. The spread between futures and spot stretches more than $120, the widest in years. Traders call it a stress fracture. When the paper price of gold disconnects from physical, benchmarks lose trust. The Swiss Precious Metals Association warns tariffs will severely disrupt global bullion flow. A pillar of the financial system begins to look shaky. Meanwhile, U.S. consumers face pressure from another corner. An AP Norc poll shows that 53% of households cite grocery prices as a major source of stress. Inflation in the food aisle has slowed since the 9.4% peak of 2022. But prices for beef, coffee, and orange juice still rise. Tariffs on imported goods are one reason. Economist David Ortega of Michigan State University explains that grocery bills shape overall perceptions of the economy. At the checkout line, tariffs are less abstract than policy papers. The Treasury reaches again for the market. It announces a record $100 billion sale of 4-week bills. MarketWatch calls it the largest ever attempt at short-term borrowing. 4 weeks buys time, but only time. Every month, that entire stack must be refinanced at the market's new rate. It stabilizes the present while multiplying the risk of the future. Europe offers little relief. The European Central Bank has cut rates 8 times. Long yields in Germany, France, and the UK still rise. Barron's points out the central bank toolkit looks blunt. If Europe cannot push yields down, why expect the Federal Reserve to succeed? Evidence mounts that long-term bond markets have decoupled from monetary policy itself. The White House defends tariffs as strategy. President Trump cites Alexander Hamilton's use of duties to raise revenue and shield American industries. But the application today stretches far beyond funding government. Tariffs on India for buying Russian oil, on Europe for subsidized steel, on agricultural imports, all are framed as foreign policy leverage. Yet the retaliation comes quickly. Partners buy less from the United States. Exports sag. Tariffs meant to assert dominance instead erode demand for American goods. Markets don't wait. After gold spikes to record highs, the president declares on social media, gold will not be tariffed. Futures tumble 2.4% to 3,407. Spot sinks 1.2% to 3,357. The Guardian describes it as a sigh of relief, but the damage is done. The threat alone reshaped hedging strategies, widened spreads, and, honestly, jolted trust in U.S. policy predictability. A promise walked back is not the same as a promise never made. Investors scan globally. In India, a 10-year bond sale collapses. Yields jump 24 basis points when banks and insurers fail to show up. In Japan, a 40-year bond auction draws the weakest demand in years. Reuters ties both to fiscal stress. This isn't just America. Across markets, buyers want more to hold sovereign debt. The shared theme is not runaway growth. It is credibility in question. At home, Bessent watches a cycle spin tighter. More borrowing lifts yields. Higher yields mean bigger interest bills. Interest bills demand more borrowing. Bloomberg calculates U.S. interest expense at over $1 trillion this year. Larger than defense, larger than Medicare. Not a projection. A line item already printed in Treasury ledgers. Cut spending, politically toxic. Raise taxes, equally toxic. Slash rates. Investors are already signaling disbelief. Tariffs, households pay the price. Gold, stability turns volatile under policy shocks. Every option that once worked delivers the opposite effect now. American consumers adapt. Surveys show families eating more meals at home, buying smaller packages, relying on coupons. Kroger reports sales in decline as shoppers switch to cheaper private labels. Mondelez, maker of Oreo and Chips Ahoy, reports a 3.5% drop in North American sales. Customers continue to spend cautiously in an uncertain economic environment, interim CEO Ron Sargent admits. A tariff war aimed at adversaries ricochets into snack aisles and grocery carts. Foreign actors notice the opening. Chinese refiners and exchanges see opportunity as U.S. demand for gold import stalls. When Americans hesitate, China accumulates. The redirection of flows is not theoretical. It shows up in customs data. What the U.S. turns away, others absorb. And yet the Treasury must press on. Another $100 billion in bills. Another auction with, well, tepid demand. Another round of yields climbing, even though we're seeing weaker labor data. In a system that was once defined by predictability, the signals now invert. Weak jobs don't lower yields. Strong productivity doesn't calm them. Rate cuts abroad don't pull them down. The feedback loop is broken. The question presses in. If the world's safest asset no longer responds to the forces that build its safety, what keeps it safe? Bond buyers are demanding more. Gold buyers are being taxed. Grocery shoppers are squeezed. Short-term bills stack like kindling. The national debt now generates an interest bill bigger than the nation's military, and each attempt to pull a lever, rate cuts, tariffs, subsidies, just tightens the knot rather than loosens it. Interest expense at $1 trillion, more than defense, more than Medicare. It's a bill that grows faster than Washington can pay it. That's where the panic begins. Not in collapse, but in the recognition that the levers of control no longer deliver the expected outcome. So what happens when every tool of power, debt, tariffs, currency, even gold, stops working as designed? If every lever now works in reverse, what exactly is left to hold the system together? Behind the flashing bond screens, another number slips out that rattles the floor. Fitch Ratings, which downgraded U.S. debt last year, warns again that the erosion of governance tied to repeated debt ceiling brinkmanship could bring further cuts if auctions continue to fail. Moody's, the last major agency with a pristine AAA on U.S. credit, has already placed America on negative outlook. A downgrade would trigger forced selling by pension funds and insurance portfolios bound by rating rules. The scale is staggering. More than $7 trillion of assets would be directly affected. In the commodity pits, the gold spike draws in unexpected winners. Dubai's exchange reports a surge in demand from American investors rerouting purchases through offshore accounts, bypassing United States tariffs and exploiting trade lanes the government cannot fully police. Singapore refiners confirm rising orders, much of it traced back to United States brokers. Policy designed to restrict imports instead accelerates offshoring of wealth. Meanwhile, consumer credit data reveals another strain. According to the Federal Reserve, credit card interest rates averaged 21.6%, the highest since records began. With 10-year yields elevated, banks price loans higher. Households' rolling balances now face effective borrowing costs above 25% at many institutions. Every uptick in Treasury yields filters down to the family level. Even Wall Street sentiment shows cracks. Bloomberg reports that foreign central banks reduced Treasury holdings by $42 billion in the last quarter, the sharpest drop since 2016. China and Japan, the two largest foreign creditors, trimmed exposure while increasing gold reserves. The IMF notes global official gold purchases remain at record highs. What Washington frames as a temporary tariff battle looks to rivals like confirmation that reliance on the dollar carries risk. That's the heart of the spiral. Every measure meant to project strength pushes capital outward. Every attempt at control bleeds credibility. And the world is watching, recalibrating, shifting wealth in silence. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.